Great. Good morning, good afternoon to everyone, and thank you for taking the time to join us today. I'm sure everybody has a busy schedule, so we certainly appreciate you taking the time to join us. So I'm Max Zerd. I'm the director here at Sustainalytics of Advisory Services based in Toronto, and will be your moderator today. Before we begin, just a few quick housekeeping items. The webinar is being recorded and will be shared with all attendees in the coming days. All participants on this call are currently muted and will be stayed unmuted until the end of the presentation. Please feel free to submit your questions via the chat box on the side panel. So you'll see that on box 1. You can also use this box to notify us if you have any difficulties with the GoToWebinar software. Finally, you can minimize the side panel by clicking on the double arrows at the top of the panel, and that would be box 2 on this slide. So again, if you have any questions, please submit them, and we'll be asking those at the end of our formal interview. Okay, so let's begin. So Russell Investments report, "Are ESG tilts consistent with value creation?" is really an original, thought-provoking piece. If you haven't had the opportunity to read it, strongly recommend you do so. We've included the link in the report in the initial invitation, and we'll also be sending it following the webinar today. We're extremely grateful to have two of the authors on the call today. We have Leola Ross and Will Pearce. Leola Ross is a director of capital markets research for Russell Investments, focusing on research publications, multi-asset solutions, and alternative investments. She has published a variety of research results and is a featured Russell presenter at conferences. Leola is a member of Russell Sustainability Council and also a member of the Academic Advisory Board for the Economics Department at Seattle University. Portfolios, including fiduciary mandates. He joined the multi-asset team in 2011 and is based in London. In addition, he has a special focus on sustainability issues and has developed the firm's approach to the integration of ESG factors within the investment process. He also serves as a member of Russell's proxy voting committee. Thank you again both for participating today. Now, the report itself differs largely from others in the field of ESG research in that it doesn't really seek specifically to find alpha signals, but rather looks for a link between positive ESG tilts and active manager decisions. Their thesis is that positive ESG tilting among active managers will indicate an implicit endorsement on the consistency between ESG factors and value creation. From their report, they go on to say, quote, "If the naysayers are right and ESG is a money-losing strategy, we should find that managers are biased against ESG. However, what they have discovered is that ESG issues represent a particular risk profile in portfolios and that active managers exhibit generally a bias towards securities with higher ESG scores versus their benchmark." This was consistent across different regions, albeit slightly different conclusions, and from this they infer that active managers have at least an implicit expectation that higher ESG scoring securities are linked to risk management and alpha creation. So maybe let's start off with you, Leola. What was the overall motivation to produce this research?
Hi, Max. Thanks for having me here today. Yeah, we had a couple things happen simultaneously that allowed this research to happen. First, there was an interest at Russell and from myself personally in ESG as an investment story. I personally have been interested in looking at different ways of viewing the market and throughout my career as well. I have been interested in both values-based and value-based investment practices. Just as a sort of definitional point, Russell sees ESG tilting and the sort of study of that as a value-based practice. And then Russell as well has the capabilities and has certainly assisted clients with values-based investing practices for many, many years. So that's kind of from me personally, and then Russell as an organization joined the UNPRI in 2011, and with it came an obligation to understand what that really meant to us, and we formed the Sustainability Council, which you mentioned. I'm a member of that. The second thing that motivated this research was actually the gift of resources, and you know, you can have all the interest in the world, but if you don't have resources, you can't do it. And we had a couple things happen. One was that we purchased the Sustainalytics data from your company, and Will, my partner today in speaking, was instrumental in both that the motivation for getting data so that we could understand ESG exposures in our funds, and then also for selecting Sustainalytics. So the data resource was important, and then secondly, I had the good fortune of a new hire on my team right around 2012, who was without projects, unlike the rest of us who have been here for a long time. And so I was able to just say, you know what, I need you to learn about this data, and he was able to do that, and he's the other author on our paper, Pay You On Song, and was able to spend a lot of time crunching numbers and developing a lot of the research that we've done. So that's really our story.
Great. Yeah. So it sounds like you had both a top-down, so joining the PRI, and a bottom-up. You had the resources. So both critical to moving the agenda forward. So that's great. You note that investors cannot assume a one-size-fits-all model will have a uniform impact globally, and that ESG appears to be an additional factor for active investors to consider. Is there any data to suggest ESG scores exert greater influence on performance in specific regions?
Well, I'm glad you've asked this question up front, because I'd like to clear the air on this, and I have actually gone to great lengths to avoid talking about performance per se. You noted that in your introductory remarks, and having the opportunity to clarify that is great. So there's a couple reasons that I've avoided talking about performance directly. One of them is that, you know, we do have a pretty short sample period here. As you know, as the promoter of this data, you know, we don't have a long back history. We don't have 30 years of data to look and see what ESG scores look like, and really the bulk of the really strong data that we have is in the last 3 to 4 years. We do have some older data, but as you know, it does look a little bit different. So I just don't feel like that kind of sample length is enough to say anything definitive. But my second point is really, I don't think performance needs to be a direct point for this to be a really important topic, and I'd like us all to understand that. So even though I haven't commented on performance per se, I've been very vocal that active managers seem to have no issue holding positive tilts according to this data, and therefore I see higher ESG scores as perfectly consistent with the intent of adding value. And to me, that's actually a much stronger point than whether or not, you know, for some particular sample period, higher ESG scores add value in and of themselves. And I think, honestly, if we're going to wait for a definitive answer on whether or not there's a direct payoff, we're just going to have a really long wait, and we need to act before then.
Mm-hmm. Yeah, and ultimately, if an issue is material, it should be included within the investment process. So due to the size of operations, corporate brands, and overall international influence, large cap companies appear to be more often exposed to ESG-driven risks than their small and mid-cap counterparts. Given large caps consistently exhibit greater ESG scores, do you feel there is a ESG-specific risk-reward trade-off that investors should explore? And if so, do you think small cap managers can still leverage the research findings?
Well, this is a big question, and I think there's a few points here. One of them is that there does seem to be something about brand reputation and stakeholders. So let's think just for a second about who are the stakeholders, particularly in larger companies. You obviously have shareholders. We always think about that from an investment standpoint. But some of the things we don't necessarily think about from an investment standpoint are things like brand and consumers and employees. And employees to me is one that I think we need to constantly remind ourselves about. And if you just think of one example, and that is compare the sort of salaries that are paid at a for-profit organization versus a nonprofit organization. And you'll find quite often that nonprofit organizations are able to get employees and people working for them for far less money. And so people have a tendency to want to work for something that speaks to them. And that's kind of how I see the impact and influence of employees for larger companies. When you have a lot of employees, when you have a lot of people who are stakeholders wanting to work for companies that pay attention to environment, pay attention to the social needs of both their employee base and the products that they offer, and then pay attention to a company that's well managed with good governance, I think is important to them. And so being able to attract and retain employees is an important sort of stakeholder influence that people need to understand and remember. As well, I think larger companies have more regulatory oversight. They're in the news more. They have to be more on the ball. If you think about all of these things at play, I think that there's really something to be said for big companies needing to pay attention to this. And so there's possibly, you know, they're big enough to have the luxury of thinking about it and maybe having people in place to answer the questions that come from Sustainalytics and think about how those questions should be answered and think about the kinds of practices they should have to get good scores from a company like Sustainalytics. But again, the flip side is maybe they're actually sort of not only big enough to have the ability to do this, but also too big to risk not doing it. And I think that's the part that we need to remember. So I think it's a great question, and I appreciate you asking it.
Mm-hmm. Thank you. No, all great points. And to your final point, yeah, I think ultimately they do have more to lose at the end of the day. I guess another distinction that was made is with ESG scores for developed markets versus emerging markets. Would you view developing markets as putting a stronger emphasis on managing their ESG capital, or can it simply be rationalized as a function of enhanced disclosure in the developed markets versus their EM counterparts?
Yeah, that's another good question. Keep in mind that sort of directionality is not universally consistent. You know, we certainly have differences from region to region. And for example, the U.S., the country that I live in and work in, has similar social scores to the emerging markets as a composite. So you know, sort of on the social scale, you don't necessarily have a clear dominance in every developed region with respect to ESG scores. However, the U.S. certainly has higher governance scores than emerging markets. So I think that there's certainly something within the regulatory system, something within the culture, something within what's required of organizations. I think another thing is you can go back to the question we just asked, and that's about the capitalization. You have, you know, larger cap companies typically in the developed markets, but EM will certainly have a smaller cap size than the developed. So there's so many things at play. It would be hard to have a definitive answer to that one.
Mm-hmm, mm-hmm. And I guess these are aggregate scores too as well. We're taking a lot of indicators under the social. So maybe if we focused in on more granular nature, then we'll see the better distinction between the EM and DM on certain social scores, for instance. I guess you did highlight the G aspect of it as well, and the report outlines that increased focus on governance is outpacing social and environmental scores. I guess how should investors interpret that finding? Is G simply something that corporates have been focusing on for a longer period of time?
I think so. If you think about where a lot of early manager research was, particularly even at Russell, G was always big on everyone's list, and you know, understanding how organizations play out is critical to a lot of investment strategies in particular. So I think that anybody who's concerned about having their shares be attractive in the marketplace would be thinking about governance in particular. Also, you know, you have hundreds of years of regulatory environments developing, and if for example, emerging markets want to be able to compete, they have to have similar transparency, similar reporting to developed markets. So a lot of these things, you know, are certainly just a part of our culture. There are a couple differences that we should note that in a number of regions, environment is actually catching up to governance as being super important. And you can certainly see that in, for example, on this side in the Europe region. And even globally, if you look at the upper end of the sort of environment distribution, that's the sort of second block in the view of these blocks. Environment is catching up, and in Japan, environment is much more important than governance. You can see that the environment scores are clearly dominating governance. I don't know, Max, it might be worth just kind of a quick review of what this picture that we're all looking at is. Would you appreciate if I did that?
Absolutely. I think all would appreciate it.
Yeah. So basically, this is sort of a standard distribution view of how ESG scores look across several regions, and it's what we call a box and whiskers analysis, and the boxes, which are the sort of colored blocks, with the blue one being the ESG composite score, the sort of tan to green one being environment. We were trying to make it as green as possible, but Russell doesn't have a true green in its color palette. So that's that second block. The third block, the sort of reddish orange, is the social score, and then the fourth block is the governance score. And so at the bottom of the block is the 25th percentile, and then you see a line going down below, and that's the what we call the whisker part that goes down to the 10th percentile. And then at the middle of the block, you'll see a line which is the median ESG score, and then you go to the top of the box, that's the 75th percentile score, and then you go to the top of the whisker above the block, and that goes to the 90th percentile. And just a couple things I would highlight is that, first of all, these are cap-weighted percentiles, which means that what we do is we take, for example, the ESG score, we rank it from the lowest ESG score to the highest ESG score, and we add up the capitalization of each of the firms until we get to that 10th percentile, and that's the bottom of that sort of lower whisker, and so forth till we get to the 90th percentile. So the 90th percentile is the 90th cap-weighted percentile of ESG scores in any particular market. And then there's a couple dots on there. You'll see a red dot sort of floating around, and that's an equal-weighted ESG score. So if we were to just take all of the stocks in the index and equal weight the impact of those stocks, you'd have that red. You'll notice the red lies below the other dot, which is the blue dot, which is the cap-weighted, which is the typical weighting we often see in investment scoring. And so because the red dot is below the blue dot, we know that capitalization matters and that larger cap companies have higher scores than smaller cap companies. And then, you know, just to talk a bit, that we've got the Russell 1000, which clearly represents the United States. We've got the Topics, which describes Japan. The Russell Europe Index, which is a pan-Europe index that includes UK and continental Europe. And then we have the Russell Global Index, so that you can see not only the level of these various regions compared with each other, but then also how they change over time, with the sort of first set of blocks in each picture representing the third quarter of 2011, which is the earliest very robust data that we have. And then the more recent one is the September 30th, 2014 number. So you can see that increase over time that hopefully we'll touch on. And then I've dropped in a blue line right at the 50, so people can kind of have a reference point. So a score of 50 is right where that blue line is, and that kind of helps you see how far everybody is from the 50. And so that's a brief description of what we've been talking about. Did that sound good to you, Max?
That's absolutely great. Thank you for that description. I think it was very clear to all. I guess one thing that we notice on this slide is that ESG scores are increasing over time globally, overall scores. So how do you envision the scores will evolve in the next few years? Do you have an opinion on that? And do you think overall ESG performance will keep trending upwards? And so, yeah, what would be the...
Yeah, as you can see, they have kind of trended upwards over time, and it's a little more subtle in some regions than others. You know, I can't really say what's going to happen in the future. It's certainly possible that they continue to increase. There's certainly more and more scrutiny on this, but really only time will tell. It's not something that I'm forecasting at this point.
Mm-hmm. You don't want to go out on a limb?
No, but we all are waiting with bated breath to see.
Absolutely. So maybe we'll switch gears to Will now. And in the report, you stated that more than 50% of the manager universe has a score that is higher than the cap-weighted benchmark. Now, wondering if manager style was incorporated into your analysis, and if so, have you found any evidence that certain styles, so for instance, value versus growth, can benefit from your findings more so than others?
Well, thanks for that, Max, and hello, everybody. To answer your question directly, we didn't incorporate here explicitly in the published piece manager style. That said, we would have some priors certainly about how certain investment styles and even certain sub-styles might look in terms of exposures to different scores. So, for example, one prior would be that value-oriented managers, on average, would have exposure to lower scores, particularly the kind of value manager that look at that sort of favor recovery type situations, distressed stocks, that kind of thing. Likewise, in the consistent growth or quality growth style of the growth universe, one prior I would have would be that we would see relatively high scores, exposure to high ESG scores, and that would be on the basis that the kind of companies that managers in that style own tend to be larger cap. They tend to be have strong financial metrics. They tend to be leaders in their industry, if you like. So again, that would be one prior. Also, there are lots of styles and sub-styles that perhaps where we have to stand back and say we wouldn't necessarily expect to see strong or weak scores per se. So, for example, some of the multi-factor quants, for example, and various other sub-styles as well. So it's usually important to sort of start off and have an expectation of what you might want to see before you actually get the data. Having said all that, we did do some initial work in the US market, and it's something we would certainly look to build out across other regions. And within that, the value managers appear to be, as we'd expected, relatively low scoring on the governance criteria. That's managers probably picking up weaker managed companies and looking for the alpha opportunities there. On the growth side, again, initial indications whether the scores were actually quite negative, perhaps more negative than we would have expected, and we'd attribute that in large part due to the market cap effect that Leola just referred to. So that's managers in this space looking for the really high growth companies, and in doing so having to go down the cap scale, and then taking on some of the lower scoring names there. So there's more work to do, but that's where we've got to so far.
Thank you. And I guess one of the big conclusions or thoughts behind the report is that there is information in ESG scores that could assist active managers in the security selection process. So information really that's not explicitly being considered by managers. Perhaps you can provide an example of such information.
Sure. Yeah. I mean, our basic view is that good managers should be looking to incorporate all relevant information all of the time. Frankly, a lot of the emerging ESG issues we see may well already be incorporated by the better managers without necessarily being flagged or sort of coming under the name ESG. I think Leola referenced before, one issue that we've certainly known for many years, which is in the emerging market equity space. The focus on governance has been very high for many years. I mean, I've looked back at research notes that our analysts have written over time, going back many years, and I've seen direct reference to that. In the last couple of years, we've seen supply chain issues impacting sort of brand reputation. Various developed tech companies have been sort of caught by that, and then maybe going back to 2012 and 2013 in particular, I think one sector that was going through certainly much less tough times than they are today, the mining sector. There were various social issues impacting companies that had exposure to Africa. So a lot of these issues share a certain characteristic, and that is that they're sort of high impact but low probability events or issues. Somewhat, they tend not to be financially tractable, if you like, very long-term horizons. And really, it's for managers, the better managers, to weigh up these issues and the potential impacts on outcomes with a host of other intangible influences that impact name selection and weightings in portfolios.
Yeah, I guess when we talk about practical suggestions or approaches for managers, I think the report definitely clearly outlines a few that managers can implement right away. Are there any general suggestions you would make to active managers in terms of how they can incorporate the findings into their day-to-day operations?
Well, yeah, there's certainly a few. I mean, one is just sort of armed with the knowledge that a lot of the active management universe appears to be exposed to higher scoring stocks, and also that there is a fairly obvious trend, particularly in certain regions of the world, including Europe, that investors and asset owners are more interested in this space. I think it's as well that managers have some of the basic tools, the basic frameworks to understand and analyze where they are in portfolios. So having access to scores, having access to the data, maybe at the portfolio level, focusing on some of the lower scoring names. Reevaluating an investment case, reevaluating and retesting conviction in names is probably a good starting point.
Great. I guess one of the aspects on this study that may not have been touched on, but is certainly a big part of the market, is passive investment. I wonder how, if at all, can passive managers leverage your data findings?
Yeah, that is a difficult question to some degree. I mean, for a large part of the assets invested in passive, that will be cap-weighted passive. And in that sense, they would generally have exposure to the whole market. I mean, I think the one point I'd make here is that I think it's fairly obvious to most people who observe, new product launches around the market, is that passive is changing. There are newer forms of passive and smart beta strategies being launched out there, and to some extent these are non-cap weighted. And not only that, some of them also have explicit style characteristics as well. The net impact of that may well be that scores actually fall. The ESG scores actually fall for the reasons we've sort of talked about before in terms of market cap exposure.
And when we think about the study period, as Leola mentioned, it's still relatively small, 3, 4, 5 years. And I guess much of this time was really in a bull market environment for certain regions in the world. Do you have any thoughts or indications that findings would remain consistent in a bear market, in the sense that scores are improving?
Yeah, that's a good question. It would have been great to go back a long way and look at prior periods. Certainly going back and thinking about 01, 02, maybe 98, periods in the early 90s, just those periods of the market where we did see strong market reversals and try and understand any particular patterns and biases. But as you all know, looking around the market, the availability of this kind of data it's a challenge going back more than a few years. So I think that kind of issue will be something to be tested in future. It's also worth noting actually here that certainly the U.S. market has been very strong through this period, but it hasn't been uniformly the case. So there's definitely been periods when European equities have struggled here, particularly at the start of this period. Also emerging markets as well. So it hasn't uniformly been the case that every market has been in a sort of strong, broadly bull market.
And I guess, again, we started at the conversation by focusing not on performance, but rather on different subjects within the investment process and how to kind of think about ESG incorporation. But I think stock return performance still lingers on many minds and is a question that ESG analysts constantly face. So as a follow-up to your study, are you considering perhaps exploring whether there is a correlation demonstrating the managers analyzed in the study successfully outperformed their respective benchmark on say, a total return basis?
It would be great to be able to do that. And as you said, everybody is interested in answers on that, or any useful information that can be added to the various studies that have been conducted on that topic over the last several years, frankly. But as Leola will attest, to be able to do that, you need lots and lots of data and to come up with a rigorous answer. So the best we can do for now is to say that we know that ESG is consistent with the intention of adding value, given the way active managers are currently positioned, and that's a really important thing to know.
Great, thank you. And I guess we have a couple more questions. We'll move to Leola again, and just wanted to remind folks on the line that if they wanted to pose a question, to do so, and we'll be able to address that in a couple more after this. So please feel free to submit them. So I guess what other regions are you planning to do research on? I think you're currently working on an Australia piece, right?
Yeah, we are. Australia is in the works. Australia, in many ways, looks a lot like Europe. We studied U.S. first, Europe second, and then Australia is looking very much like Europe in some ways. And so we've reported so far on almost every region that we cover at Russell around the globe. One area we can't do, of course, is small caps. So I would encourage Sustainalytics to increase their coverage. I know that that's something that you're well aware of, but it would really be great to address small cap. The other area where we'd like to do more research is fixed income, and I know that Sustainalytics data certainly can be used for fixed income, and we have started thinking about how we might do that. But this is kind of all yet to come.
Great, great. Yeah, we hear you loud and clear, and certainly working to enhance our coverage and provide more research data points for small caps. And fixed income is also a big focus for us as well. So finally, given your findings that positive ESG tilts exist in active equity portfolios, should investors be encouraged to take on a more explicit approach in their decision-making process?
I think they should. I think that the really important and good news out of this research that we've done is that nobody needs to be afraid of ESG tilts, positive ESG tilts in their portfolios, and they shouldn't be afraid to understand and think about what's happening in their portfolios. Obviously, active managers are not afraid of it, even if they're not actually thinking about it. One thing we can certainly do is improve our understanding of the drivers of these tilts and how they relate to points in the portfolio. But as Will noted earlier, the first step is just gaining that knowledge and knowing what your tilts are, and formulating views, formulating beliefs, formulating goals with respect to ESG are things that folks may want to consider. It certainly depends very, very much on the preferences and requirements of the constituents of various composite funds and institutional funds that are out there. And for individuals, it's really all about what they want to do with their money. And we encourage people to think more about it.
Great. Thanks again. So we have received a number of questions from the participants or the audience. So maybe I'll start with, how do you determine whether managers are skillful in using ESG information in portfolio construction?
Maybe I'll take that one, Max. It's a great question. We thought a bit about this when we've considered how to adapt our own manager research process and how we go about determining exactly this. And one of the things we sort of observed is that whereas if you go to certain types of manager, the more sort of structured, systematic managers, and you can get really inside their portfolio construction process, and you can talk to them about risk models and factor exposures, those sorts of things. Right now it tends to be the case that in those current frameworks, that ESG risk factors don't exist in the same way on the same sort of playing field as other known risk factors that investors are mindful of in building portfolios. So that's one sort of challenge, but fundamentally it isn't different to a lot of the other challenges that investors face, a lot of the other issues that investors should be aware of when sort of building portfolios. And it's really just about a careful, sort of mindful approach to a somewhat intangible influence on the portfolio. And to that extent, we're giving it a new name of an ESG risk factor, to the extent that that's useful. The ways that we will test managers on how they will do this is, for example, to ask whether they have some of the data that is available here, to test whether they are, in some of their research pieces, whether they are being diligent about including, the risk, the risk and return influence of these factors. It's a holistic sort of broad approach to understanding whether the manager is cognizant of the risk and return, but it doesn't lend itself, as I say, to something that a sort of risk model can produce put a number on right now.
Great. Thank you, Will. Another question that just came in. I wonder if you could, and we highlighted this a little bit during our talk today, but can you elaborate on the various ESG tilting options that you've encountered?
Sure. So there's a few different ways to think about it. As Will indicated, we have spent a fair amount of time at Russell's thinking about how to find out from managers of their own awareness of this and whether or not they incorporate it into their process. But at the same time, we actually know already what their scores are. And so it is certainly possible to use manager ESG scores as one of the decision-making choices that our clients have. So, for example, and let's keep this within the context of selecting strong managers that we rank highly. If we had two, call them what we call buy-rank managers, and one of them had a higher ESG score, say maybe top quintile, and the other one had a low ESG score, let's call it, sort of bottom quintile, and sort of in other ways they looked very similar. If we were working with a client base that had a preference for higher ESG scores, that might help influence our decision in which of these two managers we select. And what we have found in some preliminary look at work that we've done is that these scores tend to be consistent for managers across time, and so that's certainly one thing that one could do if they wanted to create a positive tilt in their portfolio. A couple other options that could potentially exist is one of them, really just talking to the manager themselves. If there are large investors who directly work with managers, they could certainly talk to them and say, I'm interested in in having a higher ESG score in my portfolio. You could certainly talk to a manager about what that might mean and if they're open to that idea. And then a third thing you could do is you could certainly weight a portfolio yourself. The thing that I think investors need to understand if they select, either of the latter two options that I've mentioned is really paying attention to the entire risk profile of the portfolio and the value add proposition that they're getting from their active management. And quite honestly, this goes right back to what Will said about taking a holistic approach to developing your portfolio. We're not suggesting that someone go out and say, gosh, I want to make sure that all the managers in my portfolio are generating top quintile ESG scores so that we're at the front of the pack, without paying attention to how that makes the portfolio look. So I think this is a critical thing for people to understand, is that the ESG is another measure to look at that can be important to understand about a portfolio. But just like you don't want to go whole hog on anything in your portfolio, you want to keep in mind what the impact is on the total value proposition that your portfolio has.
Yeah, ultimately an additional tool in the analytical tool belt, if you will, for managers to utilize. Another question, this one is a recent paper by Harvard suggests that the key to understanding how ESG impacts value creation lies in determining which ESG issues are material to that firm or sector and measuring performance against those indicators rather than looking at the broader ESG score. So how would you respond to that, given that your focus was on the more all-encompassing ESG measurements? And would the findings potentially be even more tilted if that was incorporated?
So,
yeah,
go ahead, Will.
Okay, I'll start and maybe you could finish. I mean, one thing to say is that it was important for us in selecting a data partner that we had somebody that was in fact looking at sectors in a differentiated way. It made little sense to apply a set of criteria broadly across everything, and so we're certainly pleased that we do have access to that and can look more in a more granular way at sector-specific indicators. So I think the point of the question is exactly right, and that makes a lot of sense intuitively. One thing I would say is that perhaps on the governance side, I think it's probably to some extent defensible to say that should cut across industries, that the various factors. Almost certainly on the social and on the environmental side, there are more sort of explicitly sector-specific factors and signals. So I think that's fine. I think it's exactly right. I think that the key challenge for everybody is identifying exactly what those are, of course. And again, just thinking back to the data set that we have access to, within just the social or environmental side of things, there are a whole host of indicators. Who's to say within social, for example, that supply chain incidents are much more or much less impactful on financial outcomes than, I don't know, staff training, for example. When you get really into the data issues, the granular data, that you're faced with, another set of problems, which is establishing exactly which are the most impactful on financial outcomes. But I think the thrust of the question is right, and directionally that's the way these sorts of studies will go in the future.
So here's what I would add, a couple points, and I agree with everything Will said. That was spot on. One thing is to highlight a compliment to Sustainalytics in that they have acknowledged this early on, and they have different weighting schemes for different industries based upon their internal judgments as to which scores are more influential to different types of industries. So their composites are already reflecting that input to some extent. The second thing that I would note is that when Will and I first started looking at this data, I think it was probably close to 3 years ago now, Will, one of the things we thought about doing was coming up with our own weighting scheme based upon particular things that we know well based on researching managers at Russell. And we looked across the various categories, and we looked at the amount of work that would go into actually coming up with our own scoring. And we realized that that was really a very big job, one that we were not prepared to do. So we really chose to outsource that decision making to Sustainalytics and simply use their aggregate scores, which, as I noted, already do take differences in industry into account. The second thing that I would add to Will's points is that this is why we are increasing our efforts to understand how the managers we evaluate take into account ESG scores. And really, if you're talking about a Russell that's not only managing hundreds of billions of dollars, but also overseeing thousands of managers on an annual basis, for us to make individual judgments about one score for one company from one manager, it would just be an insurmountable challenge. But for a portfolio manager, putting a portfolio of, call it 50 to 200 stocks together, for them to understand and know which things matter to the companies that they're looking at makes a lot of sense. And so this is why we are incorporating into our analysis how much attention is being paid by the managers that we review.
Great, thanks both. And yeah, to your points as well, is certainly our methodology is focused on material issues, and we do have industry-specific factors that ultimately do roll up to the final score. And I think the overall ESG scores also offer a great signal for further research. So if you are lower than your relative peers or absolute lower scores, then it is definitely an indication that the company isn't managing their overall ESG capital well. So moving on to another question, thoughts on environmental disasters and how they cascade into corporate governance transitions would be of an interest. So I think this question relates around how governance scores are improving, and maybe this is why environmental scores are improving as well. So they're thinking the fallout from Fukushima and TEPCO management disaster and the new Japanese stewardship code, for example, or the regulatory response to Hurricane Sandy in New York. So their question goes on to say, are asset owners asking the right questions to companies around the level of readiness for E concerns cascading into G issues?
Well, that's a tough one. Maybe I'll just jump in first on that. I do think that it's clear that environmental issues are definitely more front of mind for investors than possibly even 10 years ago. You certainly see the kinds of impacts on global investing and even specific corporation investing related to things like the Japanese tidal wave and certainly the the incident in the Gulf Coast region from an oil spill a few years ago. I mean, these had material impacts on markets, and anybody who actually did expect it to happen, which that would be a little bit hard to imagine given that they were, pretty isolated incidences, but anybody who could have anticipated that these kinds of problems would occur could have benefited from that. In a more general sense, looking for, sort of disaster risk among companies is I would put squarely in the E category. Certainly, in the case of several of these incidences, there were governance issues that led to poor outcomes with respect to environment, and we can certainly acknowledge that. But I don't know how to sort of look for sort of cross effects between these two kinds of scorings, as it were, at this point in time. I think that's really going back to what an individual active manager should be looking at when they're building the mosaic of their company. Understanding what all the risks are, understanding what all the potential outcomes are, and weighing that. And clearly, this is kind of the point of the whole stranded asset story that is very well known in the press right now. what are the things that could happen and what are sort of the big things that could change the value proposition that companies have. And you know, I certainly encourage people to think about that as they make their security selection choices.
Great. Yeah, stranded asset definitely on our minds as well, and something that we've been exploring for a little bit of time now over the past year. One final question, and this is an interesting one. I think it's really kind of to the style type question as well. And so how do you assess managers with different ESG scores when the individual scores may be impacted by a range of different internal ESG integration strategies? So for example, a high ESG score may be aligned to a manager's strategy of applying a positive ESG tilt to reduce risk, and a low ESG score may be aligned to a manager's strategy of applying more active ownership engagement to enhance the potential for growth.
So I would like Will to answer that first, and then I'll jump in afterward.
I'll have a quick shot. That's a very, very insightful point. The first point to make is that, as with any piece of data that you're looking at in manager research, and you know, we'll certainly go and interview managers armed with lots and lots of holdings data and performance data, and now ESG data as well. The first point is that, you know, nothing would be applied, nothing would be used to generate a view in, you know, in a very sort of simplistic, almost binary fashion. You know, good score, bad score, and what does that mean? I think the way we would try and apply this sort of data, as we would anything else, is to really get under the bonnet and understand exactly this sort of point that's being made in the question, because you can definitely have, and it would be perfectly valid for certain types of manager, and I referenced deep value managers before, to have a portfolio score that looks at a huge discount to the index and peers. For exactly the reason that, you know, that could well be the manager's alpha proposition, which is going in and buying companies that are distressed, that have perhaps been badly managed, perhaps they look very bad on a whole range of different governance criteria, and buying that stock at a cheap price. If that is the manager's alpha proposition, that's absolutely fine. We wouldn't have a particular issue with a low score in that case. And likewise, on the other side, managers that are scoring well, perhaps to reduce risk, or perhaps because it's a natural byproduct of their security selection process. Maybe it's these high quality companies, they favour these, you know, these sort of compounders through time, these mega cap sort of brand companies. You know, again, that's not a particular issue. We're not trying here within our process. It's never been the intention to make a judgment on the likely success of a strategy, the ability to add value based purely on these sort of scores. That's an interesting sort of starting point for a conversation around the manager's selection criteria, their research process, and how they build portfolios ultimately.
Great. Well, that's going to conclude.
So,
sorry, Leola. I'll let you. Sorry about that.
Oh, no. No, I just wanted to highlight, just on the heels of Will's comments, that I think the point that some investors are likely to be more active in the actual turnaround of a company or the change of a company is really a critical point for people to keep in mind. And I just would encourage investors to remember everything from shareholder engagement to the appropriateness of deep value investing in benefiting from companies improving where they're at. And so there's not only the idea of capturing value from companies going from poorer situations to better situations, but also being a part of that through shareholder engagement or even active ownership of an organization. And so I think that's a natural addition to what's been said.
Thank you. Thank you. And thank you for those closing remarks. And again, a big appreciation to both Will and Leola for taking the time of preparing and being the interviewees rather today. After the recording, we'll be sending over a copy of the recording in the coming days, along with a link to the report if you hadn't had a chance to read it. And beyond that, I wish everybody a great afternoon and end of day. Thank you all.
Thank you.
Thank you. Goodbye.